Let me start with a question that might make you uncomfortable. What would you do if your financial security disappeared tomorrow? Not in some distant hypothetical future. Tomorrow. Right now, according to recent Federal Reserve data, approximately 127 million American adults, roughly 50% of the adult population, have less than $400 in emergency savings. Half of this country cannot cover an unexpected car repair, a medical bill, or a week without income without going into debt. This isn't sensationalism. This is statistical reality. But here's what concerns me more as someone who has spent decades studying financial markets and economic cycles. We're not just talking about people living paycheck to paycheck in normal times. We're entering a period where multiple systemic pressures are converging simultaneously. Rising interest rates, persistent inflation, record consumer debt levels, a cooling labor market, commercial real estate stress, regional banking vulnerabilities. Each one of these factors alone would warrant serious attention. Together, they form a pattern that anyone familiar with economic history should recognize. I'm not here to panic you, I'm here to prepare you. Because there's a fundamental difference between being caught off guard and being strategically positioned, between reactive desperation and proactive readiness. The truth is this: financial collapses don't happen suddenly. They happen gradually, then all at once. And the people who survive and even thrive during these periods are those who understood the warning signs and took action before the majority realized what was happening. Over the next 25 minutes, I'm going to walk you through exactly what's happening in our economy right now, why 127 million Americans are genuinely at risk, and most importantly, what you can do about it, whether you currently have assets to protect or you're starting from scratch. This isn't about fear, it's about clarity. Let's begin. To understand where we're going, we need to understand where we are. The statistic I mentioned, 127 million Americans with less than $400 in savings, comes from the Federal Reserve's Survey of Household Economics and Decision-Making. But that number only tells part of the story. Let's add some context. According to the Federal Reserve Bank of New York, total household debt in the United States recently surpassed $17 trillion. Credit card debt alone has climbed past $1.1 trillion, with average interest rates hovering near 22%, the highest levels in decades. Student loan debt, $1.7 trillion, auto loans, $1.6 trillion, mortgages, over $12 trillion. Meanwhile, the personal savings rate, the percentage of disposable income that households save, has fallen to around 4%, well below the historical average of 8-10%. What does this mean in practical terms? It means that half of America is operating without a financial buffer, while carrying record levels of debt during a period when the cost of that debt is rising rapidly. This is not a sustainable equilibrium. If you study financial history, you'll notice something remarkable. Major economic disruptions follow predictable patterns, even though the specific triggers vary. Look at 2008. The immediate cause was a housing market collapse triggered by subprime mortgages, but the underlying vulnerability was the same as today: excessive debt, over-leveraging, and a widespread assumption that asset prices could only go up. Go back further to 2000 and the dot-com bubble. Different trigger, technology stock speculation, but the same underlying pattern: excessive optimism, borrowed money chasing returns, and a belief that this time is different. The Great Depression of the 1930s started with a stock market crash, but the real damage came from a credit contraction, bank failures, and a cascade of defaults as over-leveraged households and businesses couldn't service their debts. See the pattern? Economic collapses are rarely caused by a single event. They're caused by fragility, by systems stretched so thin that when something breaks, everything breaks. And right now, our system is exhibiting multiple signs of fragility simultaneously. Let me break down the four major forces that are converging to create this moment of risk. From 2008 to 2021, we lived in an anomalous period of historically low interest rates. The Federal Reserve kept rates near zero to stimulate economic recovery after the financial crisis, then kept them there through the pandemic. This created an entire generation of borrowers, investors, and businesses that only knew cheap money. But that era has ended. The Fed has raised rates from near zero to over 5% in less than 2 years, the fastest tightening cycle in modern history. This has profound implications. Every American with variable rate debt is now paying more. Every business that needs to refinance is facing higher costs. Every consumer choosing whether to borrow is reconsidering. Higher rates don't just slow down economic activity. They expose vulnerabilities that were hidden when money was cheap. We were told inflation was transitory. It wasn't. While headline inflation has declined from its peak, prices remain substantially higher than they were 3 years ago. Groceries cost more, housing costs more, energy costs more, insurance costs more. This matters because inflation erodes purchasing power. Even if your nominal income stayed the same, your real income, what you can actually buy, has declined. For the 127 million Americans without savings, this means they're not just living paycheck to paycheck. They're losing ground every single month. Here's a metric that doesn't get enough attention: the household debt service ratio, which measures the percentage of disposable income going toward debt payments. As interest rates have risen, this ratio has been climbing. More income is going to service existing debt, leaving less for everything else: savings, investment, discretionary spending. But here's where it gets more concerning. Many households took on additional debt during the low-rate period: car loans, personal loans, buy now, pay later arrangements. Those obligations are now colliding with higher rates and higher living costs. The result? Delinquency rates are rising across multiple categories. Credit card delinquencies, auto loan delinquencies, even mortgage delinquencies are starting to tick up in certain markets. These early warning signs preceded every major financial crisis of the last century. Unemployment remains relatively low, which on the surface seems positive, but this headline number masks important weaknesses. Labor force participation still hasn't fully recovered to pre-pandemic levels. Job growth has been concentrated in lower-wage service sectors, while higher-paying sectors have seen layoffs, particularly in technology and finance. Perhaps most concerning, hours worked and wage growth are both slowing. People have jobs, but they're working fewer hours and seeing smaller raises, while prices remain elevated. This is what economists call real wage stagnation, and historically, it's a reliable predictor of consumer stress. You might be thinking, we've been through economic downturns before. Why is this different? Fair question. Here's why this moment deserves particular attention. The buffers that absorbed previous shocks have been depleted. After 2008, household balance sheets gradually healed over a decade. By 2019, debt-to-income ratios had improved, savings rates had recovered, and household net worth had grown. Then came the pandemic. Stimulus payments temporarily boosted savings, but that effect has completely reversed. The pandemic savings have been spent, the student loan payment pause has ended, the emergency forbearance programs have expired. Meanwhile, asset valuations remain elevated by historical standards. Stock market price-to-earnings ratios are above long-term averages. Home prices in many markets are at all-time highs relative to incomes. Commercial real estate is showing stress, particularly in office sectors. This creates a situation where assets are expensive, debts are expensive, and household resilience is low. That's not a recipe for a soft landing. That's a recipe for vulnerability. Economics isn't just about numbers, it's about psychology. Consumer confidence, how people feel about their financial situation and future prospects, drives behavior. And behavior drives economic outcomes. Right now, despite the relatively low unemployment rate, consumer confidence surveys show increasing pessimism. People sense that something is off. They're pulling back on discretionary spending. They're delaying major purchases. They're expressing concern about their ability to maintain their standard of living. This matters because modern economies run on confidence. When consumers pull back, businesses see lower revenue. When businesses see lower revenue, they cut costs and reduce hiring. When hiring slows, consumers pull back further. It's a self-reinforcing cycle. We saw this dynamic play out in 2008, in 2000, in 1990, in 1981 and 82, and in every major recession over the past century. The trigger varies, but the psychology is consistent. Not all financial stress is distributed equally across the country. Certain regions and sectors are showing particular vulnerability right now. Cities with outsized commercial real estate exposure, particularly office buildings, struggling with post-pandemic vacancy rates, are facing potential property value declines that will stress regional banks and municipal budgets. Markets where home prices surged 30-50% during the pandemic are seeing both affordability crunches and early signs of price softening. When people owe more on their home than it's worth, the economic and psychological impact is profound. States and municipalities dependent on specific industries, energy, technology, finance, are feeling sector-specific pressures that could cascade into broader regional weakness. Why does this matter to you specifically? Because in financial downturns, the national statistics are averages. The impact on individuals varies dramatically based on location, sector, and personal situation. Understanding where the pressure points are helps you assess your own vulnerability. Now let's get practical. Everything I have laid out so far is context. Context matters, because intelligent action requires understanding. But understanding alone doesn't protect you. Action does. I'm going to provide specific guidance for two distinct groups, because your situation determines your strategy. If you currently have savings, investments, or property, your primary objective is preservation with strategic positioning. Let me be direct. Now is not the time for aggressive speculation. Now is the time for intelligent defense. If you don't already have 6 to 12 months of essential expenses in cash or cash equivalents, this should be your immediate priority. Not invested, not in stocks or bonds or crypto, cash. Why? Because in a financial crisis, liquidity is king. The people who survive disruptions are those who can meet their obligations without being forced to sell assets at distressed prices. Every major investor I've studied, from Warren Buffett to Ray Dalio to Howard Marks, emphasizes this same principle: maintain dry powder. This doesn't mean you should sell everything and go to cash. It means you should have enough liquid reserves that you never face a forced sale. Think of it this way. If you lost your job tomorrow, could you maintain your current lifestyle for 6 months without selling investments? If the answer is no, adjust accordingly. Look at every dollar of debt you currently carry. Ask yourself 3 questions. Can you afford the payments if your income dropped by 25%? What happens if interest rates on variable debt rise another 2%? If asset values declined 30%, would you still be able to service this debt comfortably? If any of these scenarios creates distress, you have fragility that needs addressing. This might mean prioritizing debt paydown over new investments. That might feel counterintuitive when you could potentially earn higher returns by staying invested, but remember, risk-adjusted returns include the risk of financial distress. Being forced to default on debt, lose a home, or declare bankruptcy has a negative return of essentially 100%. Avoiding that outcome has value, even if it means sacrificing some potential upside. I'm not going to tell you to sell all your stocks or exit the market entirely. Market timing is notoriously difficult, and sitting in cash during bull runs has opportunity cost. But I will tell you this: if your portfolio would cause you genuine distress in a 30 to 40% market decline, your allocation doesn't match your risk tolerance. This is the time for honest self-assessment. Look at your portfolio. Imagine the values dropping 35%. How would you feel? What would you do? If your answer involves panic selling or losing sleep, you're allocated too aggressively for your actual risk tolerance and life situation. Consider rebalancing toward more fixed income relative to equities, more quality and value relative to speculation and growth, more diversification across asset classes and geographies, more defensive sectors relative to cyclical sectors. This isn't about predicting the exact timing of a downturn. It's about positioning yourself so that you can hold through volatility without making emotional decisions. Your ability to earn income is likely your most valuable asset. Protect it. What does this mean practically? If you're employed, make yourself indispensable. This isn't the time to coast. Deliver value, build relationships, and demonstrate clear contribution to business outcomes. If you're self-employed or run a business, focus on customer retention, cash flow management, and operational efficiency. Build relationships with your best clients. Reduce unnecessary overhead. Ensure you can weather a revenue decline. If your income depends on a single source, consider developing secondary income streams, not as get-rich-quick schemes, but as genuine diversification of your earning power. In economic downturns, the employed stay employed. The valuable stay valuable. Position yourself accordingly. This might be the most psychologically difficult guidance, but it's crucial. If you've experienced income growth over the past few years, resist the temptation to increase your fixed expenses proportionally. The human tendency is to expand lifestyle to match income. Get a raise, upgrade the apartment, get a bonus, buy a nicer car. But this creates a trap. Higher fixed expenses require higher sustained income, and sustained income is exactly what becomes vulnerable in economic downturns. Instead, bank the difference. Widen the gap between what you earn and what you need to spend. Create margin. That margin is what gives you options when circumstances change. If you're among the 127 million Americans without substantial savings, your situation is different but not hopeless. In fact, you have certain advantages. You can build from a position of clarity rather than having to unwind complex positions. You can establish good habits before they need to be corrected. Before anything else, before investing, before side hustles, before complex financial strategies, establish these 3 fundamentals. 1, track every dollar. You cannot manage what you don't measure. For 30 days, write down every single expense. No judgment, just data. You need to know exactly where your money goes. 2, separate needs from wants. This sounds basic, but most people haven't honestly categorized their spending. Housing, basic food, essential transportation, minimum utilities, needs. Everything else, wants. Understanding this distinction is the foundation of financial control. 3, create a spending plan. Notice I didn't say budget. Budgets feel restrictive. A spending plan is proactive. You're deciding in advance how to allocate your money based on your priorities. These 3 steps alone will put you ahead of most Americans, because most Americans spend reflexively rather than deliberately. Your first financial goal should be to accumulate $1,000 in cash savings, not invested, in a savings account. Why $1,000? Because it's enough to handle most unexpected expenses without derailing your progress. A car repair, a medical copay, a replacement appliance. How do you accumulate this if you're living paycheck to paycheck? Start with this question. Can you find $100 per month? That might mean cutting one subscription service, eating out twice less per month, selling something you don't use, working 4 extra hours. $100 per month becomes $1,000 in 10 months. That's your buffer. Once you have it, you'll feel something shift. You'll have room to breathe. You'll have moved from precarity to the first level of stability. If you're carrying credit card debt at 20% plus interest, this is a financial emergency. Think about this mathematically. Paying 22% interest means you need to find investments returning more than 22% after taxes just to break even. That's nearly impossible to do sustainably and safely. High interest debt is a negative compound interest machine working against you every single day. It must be addressed. Here's a simple framework. Once you have your $1,000 buffer, every extra dollar should go toward the highest interest debt first. Not the biggest balance, the highest rate. Make minimum payments on everything else, throw everything extra at the highest rate. When that's eliminated, move to the next highest rate. This isn't glamorous, it doesn't feel like getting ahead, but mathematically, it's the most powerful financial move you can make. You have 2 levers to improve your financial situation: reduce expenses and increase income. Most financial advice focuses exclusively on expense reduction. That's important, but it has limits. You can only cut so much. Income, theoretically, has no ceiling. I'm not suggesting quick rich schemes or cryptocurrency gambling. I'm suggesting deliberate investment in your earning power. What skills could you develop that would make you more valuable in the marketplace? What certifications or credentials would increase your income? What side work could you do that leverages skills you already have? The goal isn't to work yourself into exhaustion. The goal is to strategically increase the gap between what you earn and what you need. That gap, that margin, is what eventually becomes savings, becomes investment, becomes security. Here's counterintuitive advice. If you're just starting out financially, spending time learning is often more valuable than taking immediate action. Why? Because financial decisions have consequences that compound over time. A poor investment decision made from ignorance could cost you years of progress. Instead, invest time in understanding how compound interest actually works, both for and against you, what different investment vehicles are and how they function, how taxes impact financial decisions, what risk really means, and how to assess it appropriately. This doesn't require expensive courses or fancy credentials. There are excellent free resources, library books, academic papers, long-form financial journalism from reputable sources. The goal is to build a mental model of how money works, so that when you do have capital to deploy, you deploy it wisely. Let me shift to what not to do, because in times of economic uncertainty, the mistakes you avoid matter as much as the right moves you make. Financial fear triggers the same fight or flight response as physical danger. Your heart races, your thinking narrows. You feel compelled to act immediately. This is precisely when people make catastrophic decisions. Selling investments at market bottoms, taking on predatory loans, making desperate career moves. The antidote? Build decision frameworks before crisis moments arrive. Decide right now what would trigger you to change your investment allocation, what circumstances would lead you to tap emergency funds, what conditions would prompt a career change. Write these criteria down. Make them specific and objective, not emotional. Then, when fear arrives, and it will, you have a predetermined framework instead of making decisions from a state of panic. We're drowning in financial content. YouTube channels, TikTok traders, financial influencers promising to reveal the secrets institutions don't want you to know. Most of this is entertainment disguised as education. Here's a simple filter. Does this content promise specific outcomes? Does it suggest investing is simple or easy? Does it rely on fear or greed to hold your attention? If yes to any of these, treat it as entertainment, not education. Real financial education is often boring. It involves mathematical concepts, historical analysis, and discussions of probability rather than certainty. It acknowledges complexity and uncertainty. That doesn't get clicks. But it also doesn't lead you into catastrophic mistakes. Leverage, borrowed money, amplifies returns in both directions. If you borrow money to invest and the investment appreciates, your returns are magnified. But if the investment declines, your losses are magnified. In good times, leverage makes people feel like geniuses. In bad times, it destroys them. Right now, as we face multiple economic pressures, leverage is particularly dangerous. This applies to margin trading and investment accounts. It applies to borrowing against home equity for non-essential purposes. It applies to any strategy that requires asset prices to increase for you to avoid distress. The simple rule, if you can't afford the outcome if things go wrong, don't use leverage. Humans are social creatures. We look to others for guidance about what's safe and normal. In financial markets, this tendency creates boom-bust cycles. When everyone is buying, prices rise, which attracts more buyers, which drives prices higher, until eventually fundamentals no longer support.